welcome to the deep dive. Today, we're going to slice right into things, looking at the highest volume, exchange-traded funds, the ones really moving the needle, trading above 10 bucks.
Yeah.
We pulled this straight from recent screener data.
Yep.
This isn't really about buy and hold forever. It's more about understanding what traders are doing right now. Where's the action?
That's the core of it. We sifted through a ton of data, picked the top 3 by sheer volume, and wow, they tell 3 completely different stories.
Okay.
You've got a classic physical commodity play, then a super speculative bet against the market, and finally, like, a laser-focused tool on a single stock's momentum.
So 3 very different appetites.
Exactly. And our job today is to unpack them, look at how they're built, the technical signals, what the news is saying, and, how the price has actually behaved.
Right, and some of these are complex, especially the leveraged ones. We need to be upfront about the risks involved here.
Absolutely critical. So let's just state this clearly once. Everything we discuss today uses market data just for education, for illustration. It's us reporting what the data shows.
This isn't advice.
Definitely not investment advice. Investing has risks, always. And those risks get seriously amplified with these kinds of leveraged products. Okay, mandatory caution done. Let's dive in.
All right, first up, the big one in volume. iShares Silver Trust, ticker SLV. This is your classic commodities and metals ETF, right? Physical silver.
It is. It tracks the London silver price simply by holding, well, actual silver bars.
Simple concept.
Deceptively simple. Because the scale is massive. We're talking $24.29 billion in assets under management, but the portfolio, just one holding, silver.
Pure play.
Totally. That's why the expense ratio is pretty low, 0.50%, and there's no dividend. You're betting purely on the metals price.
Okay, but the performance. This isn't some slow, steady commodity climb. This thing has been on fire.
It's been incredible. The one-year return is 51.77%, and year-to-date, almost 70%, 69.81%. It closed yesterday at $44.71, basically touching its 52-week high of $45.01. It's right there.
So if we look at the technicals for that kind of move, what are they screaming?
Well, they're screaming momentum, but also maybe caution. The RSI, the Relative Strength Index over 14 days, is way up at 78.37. That's deep into overbought territory.
Okay, 78. For people maybe less familiar, when you see an RSI that high, is that like a 5-alarm fire saying sell now, or is it different for something like silver?
That's a great question. For a normal stock, yeah, 78.37 would be a huge warning sign, potential reversal coming.
Right.
But here with silver, you look at the news context, headlines like silver shines brighter than gold, the hunt for $50. It suggests this isn't just froth. It could be real capital moving into assets seen as safe or at least uncorrelated.
Ah, the uncorrelated part.
Exactly. And the beta backs this up. It's super low, just 0.39. So if you're holding mostly, say, S&P 500 index funds with a beta near 1, how much does SLV help if the market tanks?
A lot, right? It moves on its own drumbeat.
Significantly. It offers that diversification, that potential portfolio insurance, even while it's been acting like a growth stock lately.
So it's a defensive asset with offensive performance. The price action backs that up too, above its moving averages.
Way above. It's trading 8.55% over its 20-day simple moving average and a huge 39.04% above the 200-day. Strong trend.
So the trigger, the decision point now, feels pretty clear then.
Yeah, it feels kind of binary. Either it punches through that $45 or 1 cent high on big volume, maybe heading towards that $50 mark people are talking about, or
the overbought RSI finally kicks in and we get a breather, a pullback.
Exactly, a consolidation phase.
Okay, let's do the fun math. Paper money time. That 51.77% one-year gain is huge.
Yeah.
If someone hypothetically put in $10,000 a year ago, what price would they have bought at?
Let's see. To get that return up to $44.71, they would have needed to buy around $29.46 per share.
Okay, $29.46. So 10 grand gets you about 339 shares.
Yep, 339 shares.
And today, those 339 shares at $44.71 are worth, quick math, over $15,000.
$15,164 roughly.
So that's a paper gain of about $5,164 on silver in 1 year.
Yeah.
That's not your grandfather's safe haven asset.
It really shows how even defensive assets can deliver aggressive growth in the right environment. Capital preservation met momentum.
Okay, let's shift gears completely. From physical safety to, well, betting on the sky falling, at least for tech stocks. Next up, ProShares, Ultra Pro Short QQQ, ticker SQQQ.
The polar opposite of SLV. This is designed for market skeptics. It's a leveraged inverse ETF. Meaning it aims to deliver 3 times the inverse of the daily return of the NASDAQ 100 index. So if the NASDAQ 100 goes up 1% on a given day,
SQQQ should drop 3%. Ouch.
theoretically, yes. And the key word there is daily. This resets every single day.
Right, that daily reset is crucial. It's not meant for long holds, is it? What happens if the NASDAQ just chops around sideways for weeks?
That's where the danger lies. It's called volatility decay or compounding risk. Even if the NASDAQ ends up lower over a month, if it zigzagged violently to get there, SQQQ could still lose money. It erodes value over time due to that daily rebalancing.
And the performance numbers show that risk starkly.
Oh, absolutely. The 5-year return is minus 97.64%.
Minus 97%.
Yeah. That's the compounding decay in action over the long haul. It's almost guaranteed to lose value over long periods, especially in a bull market like we've mostly had. The 1-year return is also rough, minus 58.99%.
So it's been hammered because the NASDAQ's been strong. It closed at $14.50, which you said is
Just barely, 0.55% above its 52-week low of $14.42. It's scraping the bottom.
But despite this performance, it's got huge volume, like massive liquidity. Average volume near 100 million shares. Why?
That's the fascinating part. The flows. People are actively trading this thing in huge size. Look at the recent money coming in.
Yeah.
In the last month alone, inflows are up over 32% over the last 3 months. A staggering 67.95% increase in assets.
So traders are piling into this thing that's near its lows, betting heavily against the NASDAQ.
Exactly. They're either hedging existing long positions or making outright bets that a significant market correction, especially in tech, is coming soon. The beta confirms this extreme stance. It's aggressively inverse at minus 3.33.
And the technicals reflect that beatdown price, RSI low.
Very low. The RSI 14 is at 30.28. That's right on the border of being considered oversold. It tells you the NASDAQ has been relentlessly strong, pushing SQQQ down.
Makes sense. And the news narrative you picked up.
It mirrors this positioning. We see headlines mentioning things like AI fatigue hits tech biggies, or investors actively looking at inverse ETFs because of recession worries. People are getting nervous about the tech rally.
Okay, one detail here shows a high dividend yield, TTM dividend of 12.41%. That seems odd for something losing so much value.
Yeah, that's really misleading. It's not a dividend in the traditional sense, like from company profits. It's more of a byproduct of the swap agreements and the mechanics the fund uses to get that inverse exposure.
So don't count on it like income.
Absolutely not. It's highly unstable and just part of the fund's complex structure, not reliable income at all.
Got it. Okay, pick money time again. Let's illustrate why traders use it despite the risks, that short-term pop potential. The sources mentioned a past spike, right? Like 32.74% in a month back in March 2020.
Correct. During that market volatility. So let's say someone felt a similar shock was coming and bought $10,000 worth near the recent low, say $14.42.
Okay, $10,000 at $14.42 gets you 693 shares.
Right, 693 shares. Now, if that hypothetical 32.74% spike happened again, maybe triggered by some unexpected news.
The share price jumps from $14.42 per share. Exactly.
So those 693 shares are now worth over $13,000.
Around $13,271.
Meaning a quick paper profit of roughly $3,271. That's the allure. Big gains fast if you time a downturn right.
That's the trade-off. Huge risk, potential for huge rapid reward in the opposite direction of the market. All right, we've done safety with SLV, skepticism with SQQQ, now for something completely different. Pure concentrated single stock momentum. Our third high volume player is Direction Daily TSLA Bull 2X shares.
TSLL. Yeah, this one takes leverage and focuses it like a magnifying glass on one single highly volatile stock, Tesla. TSLA.
So it aims for twice the daily gain of Tesla stock.
Exactly. 2x bullish exposure, resetting daily. Again, that daily reset is critical.
And the volume on this is even bigger than SQQQ.
It's massive. Average daily volume over 144 million shares. Assets under management around $7.66 billion. There's huge trader interest in amplifying Tesla moves.
And Tesla moves a lot. The performance numbers must be wild.
All over the place. Look at the recent short-term numbers. Half-year performance, up 102.94%. Quarter, up 77.39%. Month, up 50.90%. Huge gains recently.
There's always a but with leverage.
Year to date, it's down 27.32%.
Wow. So it shows exactly how leverage cuts both ways. Big wins, big losses. The beta must be high too.
Very high, as you'd expect. It's 2.87, confirming it moves with much higher volatility than even Tesla itself, which is already volatile.
Now, the flows on this one are interesting too, right? You said something counterintuitive was happening.
Incredibly telling. Despite those monster recent gains up 77% in a quarter, remember the fund has seen significant outflows.
Wait, outflows. It's ripping higher. The people are selling. Why?
Because the traders using this likely understand exactly what it is. They're not holding it for 3 months. That 77% quarterly return, that's a signal to take profits.
Ah, so they're locking in gains because they know about the volatility decay, the risk of holding too long.
Precisely. They see these huge spikes as selling opportunities, not a sign to hold on forever. They're using it as a short-term trading tool, exactly as intended, and avoiding that long-term compounding decay we talked about with SQQQ, savvy profit-taking.
Makes sense. So where's the price now? Still strong technically despite the outflows.
Technically, yes. It closed at $20.01. Now, that's way off its 52-week high of $41.50. But incredibly, it's still 218% above its 52-week low of just $6.29.
218% from the low? That's astronomical.
Shows the recovering power. The price is well above its 50-day moving average by 29.61% and its 200-day by 30.76%. So your medium-term trend is still up, technically.
But with this one, maybe more than the others. News about the underlying stock, Tesla, is everything.
Paramount. Absolutely critical. The price jumps on news like the robo-taxi release announcement, but it also got crushed, dropping 28.50% previously on news of an epic TSLA stock skid. It lives and dies by the daily Tesla headline.
Okay, final paper money round. Let's use that stunning 3-month performance, 77.39% gain. If someone jumped in 3 months ago with $10,000, what price did they buy at?
To get that 77.39% return up to the current $20.01, the price 3 months back would have been around $11.28 per share.
Okay, 10K at 1187 shares.
887 shares sounds right.
And today, those 887 shares at $20.01, that's almost $18,000.
$17,744, give or take.
So a paper profit of roughly $7,744 in just 3 months on a $10 hypothetical bet. That really highlights the sheer power and the danger of that 2x leverage on a volatile name.
Dizzying is the word. Both potential upsides and downsides.
Yeah.
Hashtag outro. So looking back at these three, SLV, SQQQ, TSLL, it's just fascinating, isn't it? The range of what high volume traders are doing.
Totally different strategies revealed by volume.
Yeah, you go from SLV, that defensive, almost traditional commodity play, seeking stability but finding massive growth.
To SQQQ, which is pure aggressive hedging or betting on a crash.
And then TSLL, which is hyper-focused momentum trading on steroids. It shows a huge spectrum of risk appetite and sophistication out there.
And the technicals paint that contrast perfectly. SLV, way overbought near 78 RSI, but low beta, steady growth. SQQQ, nearly oversold, RSI near 30, but with that huge negative beta, screaming fear.
And TSLL, just pure volatility, high beta, huge swings driven entirely by Tesla news and that leverage factor.
So the big picture takeaway.
I think it's clarity on ETF types. SLV gives you easy access to an asset class, silver, pretty straightforward. But SQQQ and TSLL, these are not buy and hold investments.
They're trading tools.
Exactly. Complex trading instruments designed for daily performance. That compounding, that volatility decay, it makes them generally unsuitable for long-term holding. They're built for speed, magnifying short-term moves, up or down. Big potential wins, big potential losses.
Okay, so reflecting on all that, especially the massive recent inflows into SQQQ, that anti-NASDAQ fund, here's something for you, our listeners, to think about.
Yeah.
Given that huge surge of money, betting against the tech rally via SQQQ, nearly 68% increase in 3 months. What non-obvious event, what potential negative catalyst might these high-volume traders be anticipating that maybe the broader market, the NASDAQ itself, hasn't fully priced in yet?
Good question. What are they seeing or think they're seeing?
Something to mull over.